Hi, this is Professor David Lopez, and I'd like to welcome you to Financials for Entrepreneurs, Part 1. Every entrepreneur makes important decisions and sometimes takes sizable risks rather than use fact-based information. Making important decisions based on hunches or past habits can increase risks unnecessarily. Basically, business decisions come from three main sources. They can be hunch-based, which is utilizing emotional rather than logical techniques, thinking from your gut. Unfortunately, every hunch has several failed hunches, so you might not get to where you want to be the most efficient way possible. They can be habit-based business decisions, and they rely on the way we've always done it type of thinking. This ends up in a rut, and it resists innovation. Smart entrepreneurs make information-based decisions. The first step in making information-based decisions is to determine what information is needed by the management team to run and build the company. There's a process used by entrepreneurs to define and utilize information that will enable them to successfully manage and grow their business. Let's take a look at what information is necessary to make these types of business decisions and a process to get that information. First, a good strategy is to list 10 of the most important decisions needed to grow the business. In other words, prioritize them. List the activities that you want to monitor. Some of the common activities would be cash flow, sales levels, credit, and collections. Define the data that's needed. From each department, determine a source and a flow of financial information. Next, collect the data. It could be weekly, daily, monthly reports into accounting software or sent out to your CPA. Next, make sure that the data is in standardized and industry-accepted forms and spreadsheets. You can use it to detect trends, past performance, as well as performance against benchmarks. Using the data should be reviewed on a quarterly, weekly, semi-annual basis. For use with your operations team on a weekly basis would be best. Reviewing this periodically helps to implement the ideas and information you're able to gather on a regular basis. Whether you meet with your CPA on a yearly basis or your management team on a monthly basis, managing by information is the best way to go. All entrepreneurs need advice on important issues from time to time. Many have boards of advisors, boards of directors as well, also consultants and attorneys. The one area that is critical when it comes to financials would be accounting advice. Most consultants recommend getting a board-certified CPA. What do CPAs offer? Obviously, they'll do the year-end tax documents, but they can also help set up an accounting system with balance sheets, income statement, and cash flow statements. They can also give business advice and opinions to third parties as well. If you're not comfortable getting a CPA just yet, there are also public accountants, business advisory services, franchises that offer business consulting services, as well as business brokers. What do you need to know about your CPA? Well, first of all, they have to take exams and be licensed. They have continuing education requirements. But not all CPAs are created equal. Some of the things you might want to check with your search for a CPA would be, do they have experience with a similar industry? Do they file reports on time? Can you level with them and be honest? In other words, are they available during times other than tax time? Most entrepreneurs get to find out about CPAs through referrals from friends or other business professionals. A strategy might be to differentiate between large and small firms. Once you've done that, setting up an interview with the CPA and obviously asking for references. There's a sample engagement letter available. There's a number of them available for review, and you can get a sense of what your letter of engagement should be on a specific basis. This leads us to discussions involving financing for entrepreneurs. All entrepreneurs have one thing in common, and that's the need for capital. Let's review the key steps to obtaining financing for a small business. First of all, entrepreneurs need to be realistic when seeking capital. Several questions must be answered in order to create a realistic view of the financial situation of the business when looking for financing. What are the economic conditions? Is the economy in a growth mode or is it contracting? What is the personal credit worthiness of the individual, the CEO, the entrepreneur that's seeking financing? What is their credit rating? What's their personal business history? It's very important to understand the reasons for financing. If it's for salaries or bonuses, etc., you probably won't get the capital you're going to need. If it's for operating or growth strategies, you have a better shot at receiving that capital. Be very specific about the amount needed and the use of the funds. What type of financing are you trying to get? Is it debt? Is it equity? Or is it a combination? Also, understanding the timing of when you need the money is critical to the process as well. Use your cash flow analysis to determine the best time to require financing for growth. There are a number of different sources for capital, but the bottom line, banks lend after your business is established and not usually for startups. If your business is established, we can now talk about what bankers want. Bankers are very interested in the personal situation and personal information of the entrepreneur. Remember, 65% of business financing is done by banks. But what they're looking for specifically encompass the 6 C's of credit: character, capacity, conditions, collateral, credibility, and contingency plan. Banks are very, very conservative, and they focus on personal relationships that they get through referrals. If the entrepreneur has an existing personal banking relationship, that always helps as well. Now let's take a look at who invests in small businesses. Again, there are 2 categories of financing that you're looking for: debt or equity. Your choice of the different categories will determine who is appropriate to go after to receive capital. So first of all, it's up to you. Remember, it's you, Inc. So there's a bootstrapping strategy: self-funded, sweat equity, letter of credit from the bank, borrow from your 401k. Maybe it's your friends and families and fools. They believe in you and they know you. The Small Business Administration guarantees bank loans through their 7A program. Once your business gets going, you can finance your growth through operations if there's enough cash flow to do it. Entities called factors are out there that are able to buy receivables at a discounted rate to cash flow. Trade credit. Suppliers want to see you successful so they can sell you additional supplies. So they're often able to extend trade credit. Don't forget leasing companies. Leasing companies allow small businesses to gain a benefit from equipment without a large capital expenditure. Last but not least, angels and venture capitalists. These are entities that provide capital in exchange for a very high percentage of ownership. They generally only invest in companies that have extremely high growth prospects. I'd like to thank you for listening. This has been Professor David Lopez. Have a great day.